Hello and welcome to helpyourmath.com. In this video on the costs of home ownership, we're going to discuss closing costs and recurring costs. So first of all, what are closing costs? These are costs associated with buying a home. It's a one-time cost that's due at the time when the loan is finalized. In addition to paying interest and principal each month, buyers often establish an escrow account through their mortgage lender. An escrow account is maintained by the lender and is used for paying property taxes and homeowners insurance. Thus, if you choose to go through with an escrow account, you will have to make a deposit into your escrow account as part of the closing cost fees. So you want to keep that in mind. Escrow accounts are really nice because it just takes a couple other bills and just the lender will then pay them off for you so that it's one less thing that you have to think about as the home buyer, which is great. Let's look at some of the common closing cost charges. Before you get to the closing, you should absolutely make sure you know exactly what you're paying for at the closing. You'll need to bring a check for this amount on top of signing whatever you need to sign for the mortgage. So these are some, you should discuss these and the fees and any fees that are waived before you get to closing. So you might have to pay a loan origination fee, a broker loan fee, a lender document and underwriting fee, transfer tax, title services and lender title insurance, government recording charges, that escrow deposit we talked about in the previous slide, and any daily interest charges. Again, make sure you know exactly what you're paying for, where the money's going before you get to the closing. In addition to closing costs, there's other things you might need to bring at the time of closing. So you want to keep these in mind and these are things you want to keep in mind. Make sure you have money for the down payment, so you might have to have a check for that. The traditional down payment is 20% of the purchase price. However, if that's more than you can afford, there are programs that can help you, such as an FHA loan. You'll also need to provide proof that you have adequate cash and income to qualify for the loan. That might include copies of bank statements and recent pay stubs. And you're also going to need to show that you have the ability to make monthly mortgage payments. Some anticipated recurring costs that we'll talk about are property taxes, homeowners insurance, umbrella insurance, maintenance, and HOA fees. So property taxes, these are usually paid quarterly. That's why if you have an escrow account set up, you don't have to worry about this because you're just paying it monthly and the lender is going to pay these for you. Property taxes can be a few thousand to tens of thousands of dollars per year. And so you really need to take this into account when you're buying a house because this is in addition to the principal and interest that you're going to be paying monthly. You'll also need to buy a homeowner's insurance policy. This covers losses due to fires or storms. However, you do need to check your area to see if you need additional insurance. Some flood zone areas will require additional flood insurance, or if you're in a hurricane-prone area, you'll need hurricane insurance. If there is a flood in your area and you don't have that additional flood insurance, your insurance may not cover any, or it might just cover a small portion of the actual damage. I recommend looking into umbrella insurance. It covers personal liability costs above the homeowner's insurance. Specifically, if there's injury to someone else or to their stuff on your property, umbrella insurance can help with that. Now, another thing to consider is the maintenance of your house. Whether it's brand new or if it's 150 years old, there's always going to be some sort of upkeep that needs to happen. So no matter what kind of a house, you could always end up with a leak or clogged pipes. You need to make sure that you can afford a plumber. It's a good idea, even if you can't think of any specific projects off the top of your head, to set aside a certain amount a month or to have a certain cash supply so that you can cover unanticipated costs. And also, you might live in a place where there are HOA fees. That's a homeowners association fee. It may include lawn maintenance or use of a community pool or a community gym. Or if you live in a condo or co-op, you might need to pay for doormen and women and or porters. So those are another monthly fee that you pay in addition to your mortgage and your insurance. All right, let's wrap this all up by looking at an example. Raymond and Kevin want to purchase a house. They offer $500,000 with 20% down. They are pre-qualified for a 30-year loan at 3.0%. Property taxes are estimated to be $6,000 a year. Homeowners insurance is $2,500 a year, and the umbrella insurance is $75 a month. Using these amounts, what is Raymond and Kevin's down payment? Then calculate their anticipated monthly expenses. You'll notice here I didn't include anything about maintenance, but that is something that Raymond and Kevin definitely want to keep in mind. Okay, so first we need to figure out the down payment. So the down payment, remember it's set up there that they're offering 20%. So it would be 20% of 500,000. When we multiply with a percent, we need to convert it to its equivalent decimal. That's moving the decimal point 2 places to the left. So that'd be 0.2 times 500,000. And we can use a calculator, or you might know a trick for calculating 20%. I'll talk about one in a second. Either way, their down payment is going to be $100,000. Now, finding 20% of a number, there is a shortcut we could use. If you look at the other number and you move the decimal point 1 place to the left, you've now taken 10%. So 10% of 500,000 would be 50,000. Well, 20% is double 10%. So if you double that, that's going to give you 20%. Double 50,000, we get 100,000. So that's my short little trick of this slide. Okay, so we have the down payment. Now, what's the amount that they need for their mortgage? What they need covered will be the offer amount. So that's 500,000 minus the down payment of 100,000. So they're going to need a mortgage for $400,000. Okay, so there's the mortgage. We're trying to figure out the monthly payments. In a previous video, I talked about a complicated formula we could use to figure out those monthly payments, or we have a handy chart that I also showed. We're going to go with that handy chart. We can use the handy chart because 3.0% is on the chart. So we're looking at 3.0% in a 30-year loan. So we're going to figure out the monthly mortgage payments next. I'm just going to write down monthly mortgage. And that's going to be, let's see, here's that handy chart. And remember, this chart shows per $1,000. So we'll still have to do a little bit of work. This isn't going to tell us their exact monthly payment yet, but it's going to really be a shortcut for us. So here's 3% right here in this row. And here's the column of 30 years. So we're looking at 4.21604. Now we'll go back and work this out for $400,000. So we have 4.21604. Remember, this was per $1,000 times 400,000. And I don't like doing all of these zeros. We're very likely to make a mistake here, so we want to be really careful. Divide by 1,000, and I'll divide by 1,000. So what I'm really going to do now is 4.21604 times 400. So the monthly mortgage payments will be $1,686.42. $1,686.42. Okay, so we have the mortgage. Let's see. We can I didn't write mortgage down. Darn, I can't check anything off. Next, we'll look at the property taxes. They're estimated to be $6,000 per year. So this is one of the things we're going to want to look at. I'm going to make a list over here. We have our mortgage. Now let's look at those taxes. And that's per year. So we want to divide this up by month. We're looking for our monthly bill. So we have 6,000 divided by 12. That's going to be 500. So the taxes each month will be 500. Okay, so that's this. Then the homeowner's insurance. I wrote home instead of home. That's okay. That's $2,500 per year. So we're going to divide that by 12 as well. This is going to be a nice approximation. We get $208.33 per month. So we're going to add that to our tally up here. 0.33. Okay, this one's done. The umbrella insurance. Oh, look, it's already per month. So we're going to add 75. Okay, so we're going to add these four values together to get a rough monthly payment and to get a rough anticipated monthly payment. And it looks like each month they're going to need to pay $2,469.75. And again, they also want to consider maintenance, or if there's an HOA fee, or if they want to get a lawn service or any other additional fees. But the minimum they need is about $2,500 just to be safe. And the disclaimer I put at the end of all of these videos is I am not affiliated with banks. I am not a lender. If you are considering purchasing a home, Absolutely ask all of these questions to your lender because you want to make sure you have answers. You want to know exactly what you're going to be purchasing. This is strictly for educational purposes. These have been examples of closing costs and recurring costs. Thank you for stopping.